Greetings, I'm Erik, CIO of the Wealth Plan Group. Today, it's May 20th, Monday, and we are in the midst of a broad-based market rally. And when we say broad-based, some people call it the everything rally, and it's true. Stocks are up across the board, whether it's small caps or large caps, whether it's value or growth, stocks are advancing. Or things like gold and silver and copper are making all-time highs. So there's a very high demand for these metals. Some would say that's an indication of a growing economic picture. And this has many saying the Fed has in fact orchestrated the proverbial soft landing with its efforts to fight inflation. Nonetheless, the economy is growing. But there is one indicator that maybe suggests some caution might be in order, and that's the inverted yield curve. Historically, when the yield curve is inverted in the modern era, it's led to a recession down the line. So the yield curve has been inverted for nearly 2 years, which is a very long period of time. But before we get into the details of the yield curve, let's just establish what in fact that instrument is. So the way a yield curve is constructed, you take the 1, 2, 3, and 6 month T-bills, link those with the 1 year, 3 year, 5 year, 7 year, and 10 year T-notes, and then take the yield of the 20 year and the 30 year bonds, link them all together and to form a curve. Now, in a normal condition, the curve is upward sloping, meaning that the further you go out in time, the higher the interest rate is on that instrument. And that's really what's going on with the yield curve when it's normal. We're being compensated for placing our capital in a locked up situation for a longer period of time, so that we're incented to take that additional risk or to accept that additional lockup. Now, currently, after the Fed has dramatically raised rates over the last couple of years and stayed here, as the Fed says they're higher for longer until inflation recedes, the yield curve has inverted, meaning that the near-term rates are quite high, approximating the Fed funds rate, and the further you go down the curve, the lower the rate of return is. So you're actually not being compensated for putting your money at risk. Now, the implication is for bond investors, and we've been a part of this trend, we're emphasizing that 1 to 2 year element of the curve where the rates are still reasonably high. We're also emphasizing some adjustable rate bonds that will reset if rates keep going up. But in that inverted scenario, there's almost no incentive to place your capital at risk. Now, from a policy standpoint, what does that mean for an investor when the yield curve is inverted, and what does it mean for the broader economy? For the investor, it means no incentive to go longer term, stay short term. In the aggregate, across the entire economy, it means that capital isn't flowing to longer term oriented projects. It's staying focused on short term. The engines of growth tend to be those longer term capital commitments that come with a longer term focus. But if you're not being paid to do anything longer term, that has in the aggregate the effect of slowing down or retarding economic activity, which is exactly what the Fed wants, to get pressure off of prices at the general price level. Here we are in an inverted curve over the last couple years, which should have the effect of slowing the economy. And it's just a question of now, how much does the economy slow? And does the economy tip into recession, or can we avoid recession? Now, there's another way to measure the yield curve. Instead of measuring it over the entire term structure like we talked about, there's a popular way to do this, which is just taking the 10-year yield and subtracting the 2-year yield. So in an upward sloping environment, say the 2-year yield was yielding 3% and the 10-year was yielding 5, 5 minus 3 equals 2. So we would have a positive sloping yield curve with a 2% premium. You can string these measurements along through time over a long period of time and look at that 10-2 spread. When it's above 0, it's a positive upward sloping curve. When it's below 0, it's a negative or inverted yield curve. So currently, very clearly, when you look at the curves, we're inverted. And if you go back all the way to the late 1970s, That's the last time we had an inversion of any meaningful duration, and it did in fact precede a couple of recessionary events. So here we are nearly 2 years into an inverted yield curve with the economy clicking along and the equity markets rallying, and we have a broad-based rally, the everything rally. Does this mean we're out of the woods? Maybe, but maybe not. We look at this current inversion and its depth and its duration, and we say we still have to see the effect of this higher for longer rate policy on economic activity. So far so good, but there's always the chance that we do get, that nasty recession in response to this rate situation. That would be normal. So we're watching it very closely. Now, the last thing I'd like to talk about is when that rate curve normalizes. So we're inverted currently. When it normalizes, what path is it going to take? If we have just a dropping of near-term rates with fairly flat response on the longer end of the curve, that'll be fairly benign. If we have an inflation scare that requires more, then we could get steeply inverted. Or if we normalize but the long end of the curve goes up as it normalizes, that could mean more losses for long-term oriented bonds. We're keeping our powder dry, not wanting to get too long on the curve until we see what shape a normalizing yield curve takes. Eventually, those longer term bonds are going to be a very good investment, but we don't think it's quite time yet. Thanks for your time. Always look forward to conversations, dialogue. If you like this, send a response, contact me. I'd be happy to have a deeper conversation. And as always, we're happy to put you in touch with our advisors here at WealthPlan. Thank you very much.